equity fee, what is it? A low equity fee relates to a mortgage. So effectively what happens is if you borrow more than 80% when you take out a mortgage, then the bank will charge you a low equity or a low premium fee. Effectively, why do they charge that? Because when they lend you 80%, effectively they've got a 20% buffer. So let's say that for some reason that you default, what they can do is they can go and sell the house and then make sure they've got their mortgage covered. So for instance, if you went and bought a house for $100,000, and which is pretty hard to do in today's economy, of course, but just to keep it simple. So we borrowed $100,000 and we put a 20% deposit down and we borrowed $80,000. Then the banks would say, okay, let's say you got into trouble, then they, as long as they sold that house for more than $80,000, they actually haven't lost any money. So if you actually borrow more than that 80%, then what they want to do is they want to make sure that they're covered in case they have to sell that house for a loss. So effectively a low equity fee covers an insurance for the bank. So let's look at some numbers for a moment. These are actually, we got this from the ASB Bank. So if you had a loan of $200,000 and you borrowed 85%, then your low equity premium would be $1,000. If you borrowed 90%, then the premium would be $1,500. And if you borrowed 95%, the premium would be $2,000. As another example, if the loan was $400,000 and you borrowed 85%, then the low equity fee would be $2,000. If 90% was borrowed, it would be $3,000. And if 95% was borrowed, it would be $4,000. So a lot of people ask, well, how do I actually pay that? You can actually write a cheque out for that, of course, but for many people who are borrowing more than 80%, they don't necessarily have those funds. So what they'll often do is add the cost of that low equity premium onto your loan. The thing you need to be mindful of is that you do pay interest on that. So for example, if your low equity fee was $3,000 and the term of your mortgage was 25 years, then the total cost of that low equity fee is going to be $7,558. And that is made up of the initial fee of $3,000 plus $4,558 in interest. So it's not just what you're actually paying in that fee, it is that fee plus the interest over the term of your loan. So it is a significant amount of money. So I guess the key thing you need to be mindful of is that if you're borrowing over 80%, in many, many cases you're going to have to be paying that low equity fee. However, it doesn't hurt to actually ask the bank and to see whether you can actually negotiate that fee down. And I understand that some banks are enabling you to negotiate that fee. The most effective way, of course, is to ensure that you don't pay that low equity fees is to have at least a 20% deposit.